Assalamu alaikum rahmatullahi wa barakatuh, my dear friends. Very interesting topic today. We're going to look at equity technical analysis. It's a very interesting topic, amazing topic. It has a lot of people looking at charts and trying to predict what's going to happen in the future. Okay. In the 1930s, there was an individual, Mr. Ralph Nelson Elliott. In the 1930s, this guy was a finance guy. He was working in the stock markets in US, and he recognized and discovered that there seems to be some sort of a recognizable trend within the market. Okay. He looked at these charts of different stocks, of different mutual funds, of different commodities, whatever you may have it, and he realized that these prices of these commodity stocks, they seem to have somewhat two cycles that it goes through. The first cycle he numbered, the second cycle he lettered. Okay, so he distributed the entire two cycles into two phases. The first phase was a numbered phase within which the market is green. And basically, what it means that the market is going to go up. So he said the first wave in the market, it's always a positive wave. Then the second wave, it is a correction. The third wave, the longest wave actually, it's a positive wave. The second wave after that, after the third wave, which is wave number 4, it's a correction. And fifth phase is the fifth wave, which is the which where the market or the stock or commodity, whatever you may have it, reaches its peak. He called this phase the positive numbered phase, the motive numbered phase, whereas the motive is basically positive. Okay. After that, once it reaches the peak in wave number 5, there is a couple of things to notice here. First of all, notice something very clearly in this graph. Number 1, 2 is down, 3 is up, 4 is down, 5th is up. So 1, 3, and 5, they are every time higher highs. 2 and 4 are the waves which are down. 2 and 4 wave, they are a higher low. So it makes every time it makes a correction, it's a higher correction than the previous correction. The next phase that he lettered was phase number B, which is in that phase, the red phase, where there will be a correction. The first wave, after it reaches the peak from the fifth line, it's going to be a corrective wave, which he called wave A. Then it will reach a bottom and it will go up again to make a little bit. Actually, if you look at the Fibonacci reference, it will be very close to the half of the wave A. It will be up, and then once that peak is reached in wave B, the last wave is going to be wave C, which is a corrective and last wave of his cycle that he assumed that this is what happens in the market. Now, this technical analysis method is well known. I'm not sure if a lot of people knows it, but it's very well known in the people who work in the stock market. They have an idea of where these how these waves can help them predict where the stock market is going to go. Okay, I have a very simple question. Let's see if this works in the Saudi market or not. So I drew up my chart. The chart is between 2007 until now. It's we are looking at least over 15 years. I want to have at least two examples that shows me and proves that it works. In these two examples, don't blink, pay attention, and see what's going on. So the first cycle I'm going to look at in this graph is going to be the period between 2007 2011. If you guys remember, this was the financial crisis, global financial crisis. So my question is that if I was within this global financial crisis at that time, do you think I would have predicted where it's going to go? Let's check. First line, up. it is a positive line. Second line, within that period between 2007 and 2011, is a correction. Third line, which is the longest line, it is up. The fourth line, it is a correction. Fifth line, it will reach the peak. These were the numbered phase. The second phase after the numbered phase would be the lettered phase, which is a corrective phase. First letter A, down. Second letter B should be up. It is up. Third letter C, it should be down. So between 2007 and 2011, it works. The Elliott wave shows and proves that it works. Again, we're back to our graph, which is between 2007 and now. Let's take our second example, which is the period between 2012 and 2016. Again, 4-year cycle. Let's look at those two dates closely. Let's see if Elliott wave works here. First wave, up. There is a correction in the second phase. There is a correction. Second phase. Third phase, it is up. Again, the third is the longest phase. Fourth phase, there is a correction. Fifth phase, it reaches the peak. Now we're going to go into the lettered phase. First wave A, down. Second wave should be up. Yes, it is. And the last wave, which is wave C, it should be down. So our Elliott wave worked twice in the past history. In the global markets trend that was in 2007 and 2011. And then the second example is 2012 and 2014. Both cycles are 4-year cycles, meaning that if you own stocks between those two cycles, it would have been very clear to you that where I should buy and where I should sell. Again, we're back to our main chart between 2007 and 2025, all the way through. We looked at uh, example 1, example 2, and now we are here. Can you guess where we are? Which wave are we going in? Is the market going to go higher or not? Please write in the comments. With that, we come to an end. Thank you very much for attending this short course. It's a food for thought. I hope now you can blink. Please, if you have any questions, let me know. This is Muhammad Al-Quraishi, your dear friend. And please don't forget to subscribe. God bless. Allah Akbar. Assalamu alaikum.